Welcome back to the deep dive. We're here to take these really complex financial topics and, well, make sense of them for you.
That's the goal.
And today we're tackling something huge, a massive shift happening in global finance, the move from public markets, stocks and bonds, over to the private side.
It's an absolutely enormous trend. I mean, we're talking about a fundamental change in how companies get funded, how deals get done. It's reshaping everything.
And right in the middle of this, you've got firms like ARES Management Corporation, ticker ARES. They seem perfectly positioned, right?
Oh, absolutely. They are a core beneficiary, maybe even a driver of this whole private market boom. That's why we're doing this deep dive.
Exactly. We've dug into a whole range of investment analysis, institutional reports, basically trying to get the full picture on ARES.
They're a top-tier global alternative investment manager. You can't really understand alternatives without understanding firms like ARES.
So our mission today, for you listening, is to really unpack ARES' business. It's enormous, over $500 billion under management. We want to figure out, okay, how do they actually make money?
And why is their model, surprisingly, so stable, compared to the ups and downs you might expect?
Right, and how are they capitalizing on these twin trends? The boom in private credit, which is their specialty, and also this move to bring alternatives to, well, more investors, the democratization piece.
We want to give you the framework, the tools to understand how these giant financial platforms actually operate behind the scenes. The scale is just immense.
Okay, let's start with that number. As of mid-2025, ARES is managing roughly $572 billion in assets under management, AUM.
Yeah, $572 billion. It's hard to really conceptualize. That puts them right up there in the top league of global alternative asset managers. They're not just participating, they're shaping the market.
Okay, $500 billion plus. Let's try and break that down. Where is all that capital actually deployed? Because ARES isn't just one thing, right? It's a platform.
Exactly. It's a platform structure. Think of it as having several interconnected businesses under one roof.
So what are the main pillars of this $572 billion operation?
There are four primary investment groups, but one of them is really the dominant force. It's the cornerstone.
That has to be the credit group, right? The sources we looked at all highlight this. It manages a massive $377.1 billion in AUM. That's as of Q2 2025 data.
Absolutely. That's nearly two-thirds of the entire firm's assets. It really defines ARES. And they're not just passively managing bonds here.
No, they're described as a formidable, self-originating direct lender. What does that mean in practice?
It means they're not just buying loans the banks have already made. They're going out and finding companies, middle-market companies mostly, across the U.S., Europe, Asia-Pacific, and structuring loans directly for them.
So they're doing the work the banks used to do, essentially, filling that gap.
Precisely.
Yeah.
Especially after the 2008 crisis, and with regulations like Basel III making it more expensive for banks to hold these kinds of loans, banks pulled back. ARES and others like them stepped right into that void. They have the capital, the relationships, the expertise to underwrite these complex deals that banks are often hesitant to do now. It's a huge structural advantage for them.
Okay, so credit is the giant engine. What's the next biggest piece?
That would be the real assets group. They're managing about $129.8 billion in AUM.
Real assets.
All right.
So real estate infrastructure.
Yeah, exactly. And they've been very strategic here, focusing on sectors like industrial properties, think warehouses, logistics centers, and also multifamily residential, stuff with pretty durable demand.
And this segment saw some huge growth recently, didn't it? Something about an acquisition.
Oh, yeah, the acquisition of GCP International, that was a massive deal. It dramatically increased the scale of the real assets group.
Was it just about adding AUM, or was there more strategy behind it?
Definitely more strategy. It significantly boosted their presence in those high-growth industrial and logistics sectors, plus it gave them a much bigger footprint in Europe and Asia. So better diversification, more global reach.
And infrastructure is part of this, too.
Yep. Within real assets, there's a dedicated infrastructure platform managing around $21.1 billion. They're focused on essential assets, digital infrastructure like data centers, renewable energy projects, transportation assets, really critical stuff.
Okay, so credit dominates. Real assets provide strategic diversification and scale. What about the other two groups? They seem smaller on an AUM basis.
They are, but they're important strategically. You've got the private equity group managing about $23.8 billion.
So classic PE, buying companies.
Pretty much. They focus on acquiring controlling stakes, or sometimes significant minority investments, mainly in middle market companies across North America, Europe, and now China, too.
Does having this PE capability help their other businesses, like credit?
Absolutely. The operational know-how they gain from owning and improving companies directly feeds back into their ability to underwrite credit deals more effectively. They understand the businesses from the inside out.
Makes sense. And the last one, secondaries. That seems like a hot area right now.
It is. The secondaries group has grown rapidly, now managing about $33.9 billion AUM. This platform addresses a key issue in private markets: liquidity, or the lack thereof.
Right. Private investments are typically locked up for years.
Exactly. So the secondaries group provides a solution. They buy existing stakes in private funds from the original investors, the limited partners or LPs who might need cash out before the fund officially ends.
So they're buying positions in PE funds, credit funds, infrastructure funds.
Across the board, it allows LPs to manage their portfolios more flexibly. It's a complex business, relies heavily on relationships, and being able to accurately value those illiquid underlying assets. The whole ARES platform helps with that valuation piece.
Okay, so we have the structure. A dominant credit engine benefiting from banks retreating, complemented by real assets for global scale, plus specialized expertise in private equity and secondaries for liquidity and operational insight.
Got it. That's the anatomy, a very integrated platform.
Now let's talk about how this machine actually generates revenue. How does the money flow in?
Okay, so when you look at how any asset manager like ARES makes money, it really boils down to two main streams. Think of it as the predictable part and the lumpy part.
The annuity versus the upside.
Exactly. The annuity is the foundation. That's the management fees. This is the bread and butter.
And looking at the numbers for fiscal year 2024, management fees were big, almost 60% of their total revenue, which was about $4.55 billion. So management fees were around $2.7 billion.
That's right. And that $2.7 billion is crucial. It covers salaries, rent, technology, all the operating costs. It comes in pretty consistently, regardless of whether the M&A market is hot or cold.
But here's the really interesting part from the analysis, the source of those fees.
Ah, yes. This is the key to understanding ARES stability. An estimated 95%, let that sink in, 95% of those management fees in 2024 came from either perpetual capital vehicles or long-dated funds.
Perpetual meaning the money stays indefinitely, and long-dated meaning locked up for a very long time.
Exactly. Perpetual vehicles, like some of their BDCs, don't have an end date. The capital just keeps getting reinvested. Long-dated funds might have lockups of, say, 15, 20 years or even longer.
So unlike a traditional 10-year private equity fund where you're constantly worrying about raising the next one.
Right. ARES has locked in a huge portion of its core revenue for the very long term. It makes the business model look much more like a subscription service than a transactional one.
That 95% figure is really striking. It massively de-risks their core operations, gives them incredible visibility for planning.
It's a huge strategic advantage.
Yeah.
Okay, so that's the stable annuity. Now for the other side,
Okay.
the performance fees, the upside, but also the volatility.
This was about a third of their revenue in 2024, around $1.5 billion.
Correct. Performance fees totaled $1.517 billion, or 33.2% of revenue. But this bucket has two main components, and they behave differently.
Okay, break those down for us.
First, you have what's traditionally called carried interest, or sometimes performance allocations. This was the bigger piece, about $1.18 billion, or roughly 26% of total revenue.
And this is the classic 2 and 20 model from private equity, the 20% profit share.
Sort of. It's typically a share, often around 20% of the fund's profits after the investors, the LPs, get all their initial capital back, plus a minimum preferred return, often called the hurdle rate.
So ARES only gets this carried interest if the fund performs well above a certain threshold.
Yes, and crucially, they only realize this money gets the actual cash when the underlying investments are sold, when there's an exit, like an M&A deal or an IPO.
Which means carried interest realization is totally dependent on the health of the capital markets. If the IPO window is shut or M&A slows down,
that carried interest might be accrued on paper, but the cash doesn't actually arrive. It's inherently lumpy, episodic.
Got it. What's the second type of performance fee?
That's incentive fees. These were smaller, about $337.6 million, or 7.4% of revenue. These are more often associated with those perpetual vehicles we mentioned, like publicly traded BDCs or certain credit funds.
And how do these work? Are they also tied to exits?
Not usually. They're often calculated based on the fund's net investment income over a certain period, say quarterly. Again, there's usually a hurdle rate involved.
So potentially more regular than carried interest?
Potentially, yes.
Yeah.
But they still have volatility. A key feature here is often the high watermark.
Ah, the high watermark. Can you explain that simply?
Sure. It basically means if a fund loses value, the manager can't earn any new incentive fees until the fund's value recovers past its previous peak performance level, the high watermark.
So it protects investors from paying fees on volatile performance that doesn't result in actual net gains over time.
Exactly. It aligns the manager's incentive with generating sustained positive returns.
Okay, so management fees are stable, performance fees are lumpy, carried interest, or somewhat less lumpy but still variable, incentive fees. To really visualize why performance fees, especially carried interest, are so episodic, let's talk about the fund life cycle and the J-curve.
Right, the J-curve is a classic concept in private equity and private funds generally. Imagine the typical 10 to 12-year life of a closed-end fund.
Okay.
In the early years, say years 1 through 5, the fund is in the fundraising and investment period. They're calling capital from investors, paying management fees, and deploying that money into buying companies or making loans.
So cash is going out, fees, investments, but not much is coming back yet because the investments haven't matured.
Exactly. The fund's net cash flow is negative. That's the initial downward slope of the J. You're paying fees on capital that isn't generating returns yet, and you're putting money to work.
And the investments are illiquid during this time. You can't just sell them easily.
Correct. Then hopefully you move into the harvesting and realization period, typically years 5 through 10, maybe even longer. This is where the investments mature, portfolio companies are improved, and hopefully you start selling them.
Exits, M&A deals, IPOs, this is where the profits are made.
That's the upward swing of the J. Successful exits generate cash flow back to the fund, paying back the LP's capital, then their preferred return, and then finally triggering that carried interest for the manager.
But if you hit a period like, say, 2023, where interest rates spiked and M&A activity really slowed down,
You get a challenging exit environment. Deals get put on hold, IPOs are delayed, that harvesting phase stalls.
and the crystallization of carried interest gets pushed out, the cash doesn't flow.
Precisely. And that's why that stable base of management fees, especially from perpetual and long-dated funds, is so incredibly valuable for a firm like ARES. It allows them to ride out those challenging exit periods without financial stress, patiently waiting for market conditions to improve for harvesting. It's a huge buffer against volatility.
A structural shock absorber built into the model. Okay, that makes perfect sense. So we've got the stability from the fee structure. But investors always want growth, right? Where does future growth come from beyond just hoping the markets are good for performance fees?
Well, a huge part of the growth story for these large managers is already embedded within their existing structure. It comes from the difference between the total assets they manage and the assets they're currently earning fees on.
Ah, the AUM versus FEUM distinction. Assets under management versus fee-earning assets under management.
Exactly. Remember the total AUM number, $572.4 billion as of mid-2025. But the fee-earning AUM, or FEUM, was lower at $349.6 billion.
Okay, so there's a big gap there. What is that $223 billion difference?
That $223 billion delta represents capital that ARES has secured commitments for, but hasn't fully deployed or activated fee structures on yet. It's the pipeline for future fee revenue.
And within that, there's an even more specific number the analysts focus on, right? The dry powder.
Yes. Within that difference, ARES specifically identified $86.8 billion in what they call deployable capital. Think of it as shadow AUM, or committed capital that's just waiting to be invested. It's not yet paying full management fees.
$86.8 billion, that's like a preloaded growth engine.
It absolutely is. This capital is committed by LPs. ARES just needs to find the right investments to put to work.
And the potential revenue impact is significant.
Very. ARES has actually estimated this. They believe deploying that $86.8 billion war chest could generate approximately $822.7 million in additional incremental annual management fees.
Wow. Almost $1 billion in new, stable revenue just from deploying capital they already have commitments for?
Exactly. It provides incredible visibility into future management fee growth, largely independent of new fundraising success in the short term. The main task is just prudent deployment.
That's a powerful story for investors. High visibility, low execution risk on that future revenue stream. But it's not just about deploying existing capital, it's also about the type of capital they're raising now, right? Back to this perpetual idea.
Yes, this is the strategic long game, the focus on raising perpetual capital. These are funds, again, with indefinite lives. The capital isn't returned after 10 years. It's continuously reinvested.
Creating a permanent, growing base of fee-earning AUM.
Precisely. It acts like a flywheel. The longer the capital stays, the more stable the fees, and the more it compounds over time. It fundamentally changes the nature of the asset manager's business.
And Ares is leaning heavily into this strategy.
The numbers are clear. Perpetual capital hit $166.6 billion in Q2 2025. That's up 43% year over year. That is extremely fast growth in the stickiest, highest quality capital category.
43% growth in perpetual AUM, that's aggressive.
It shows a deliberate strategic shift. And look at the overall structure now. 82% of Ares' total AUM is housed in either perpetual or these long-dated funds.
82%. That's the vast majority.
And the impact on revenue is even more dramatic. In Q2 2025, those stable, long-duration vehicles generated 91% of the total management fees.
Okay, so the core revenue engine is overwhelmingly built in this stable long-term capital base.
It fundamentally shifts the company's profile towards stability and predictable compound growth. It's less like a volatile hedge fund and more like a financial utility in some ways, but with growth potential.
And we see examples of these perpetual vehicles publicly, right? Like ARES Capital Corporation.
Absolutely. ARES Capital Corporation, ARESCC, is a perfect example. It's a publicly traded business development company, or BDC. It raises capital in the public markets and acts as a permanent pool of capital for the credit group to deploy into middle market loans, generating fees and interest income consistently over time. That structure is a key part of the perpetual capital strategy.
Okay, the internal mechanics look solid. Stable fees, embedded growth, focus on perpetual capital. Now let's zoom out. How does Ares fit into the broader industry trends? What are the tailwinds helping them?
Well, they're operating in an industry that's just exploding. The overall alternative asset management space is projected to grow massively from around $15 trillion in 2022 to potentially over $24 trillion by 2028. That's the macro supercycle they're riding.
A rising tide lifts all boats, but what specific currents are benefiting Ares most?
Two huge ones. First, the structural shift we touched on earlier. Companies are increasingly choosing to stay private for longer.
Why is that? Avoiding the quarterly reporting pressures, public scrutiny.
That's a big part of it. Plus, there's just so much private capital available now. They often don't need to go public for funding or liquidity. This massively expands the potential market for private equity, and especially private credit providers like ARES.
And the second big tailwind?
The ascent of private credit. This is probably the single most important trend for ARES, given their DNA. Private credit has become the fastest growing major asset class globally. Its total AUM was nearing $2 trillion in 2024.
And this growth is directly linked to banks pulling back, right? The Basel III effect.
Directly linked. Post-2008 regulations made it more capital-intensive, less profitable for traditional banks to hold certain types of corporate loans, especially to mid-sized or complex companies. They retrenched.
Leaving a huge financing gap.
A massive void. And firms like ARES, with their large pools of unregulated, patient private capital, stepped right in to become the new lenders to vast swaths of the corporate world. ARES' deep expertise in credit makes them perfectly positioned to capture this shift.
But there have been headwinds too, right? It hasn't all been smooth sailing for the industry, especially in fundraising recently.
True. The main challenge, particularly in 2023 and early 2024, was the denominator effect.
Right. Explain that one again. It affects institutional investors mostly.
Yeah. Picture a large pension fund or endowment. They typically have target allocations, say 10% to private equity, 15% to private credit. These allocations are percentages of their total portfolio value, the denominator.
Okay.
If the public markets crash, stocks and bonds go down, the value of their private assets, the numerator doesn't change as quickly because they're illiquid and valued less frequently.
So suddenly, their private allocation might jump from 10% to 12% or 13% just because the public market side shrunk. They become over-allocated.
Exactly. And when they're over-allocated, they often have to pause or slow down, making new commitments to private funds until their portfolio rebalances. This caused a temporary slowdown in fundraising across the whole alternatives industry.
But did this denominator effect hurt all managers equally?
Interestingly, no. It actually tended to benefit the largest, most established managers, the Blackstones, the Apollos, the Ares of the world.
How so? A flight to quality.
Precisely. LPs still wanted exposure to alternatives, but with limited capital to deploy, they prioritized committing to the managers with the longest track records, the biggest platforms, and the perceived safest hands. So the giants often took market share during that slowdown.
Scale becomes a defensive advantage. Which brings us to Ares' specific competitive advantages, or its moat. What makes it hard for others to compete with them?
Several things. First is just sheer scale and integration. Managing over $500 billion lets them underwrite enormous, complex deals that smaller firms simply can't touch. But crucially, the platform is integrated
Meaning the different groups, credit, real assets, PE, talk to each other.
constantly. Insights flow across the platform. If the real estate team sees weakness in, say, office properties in a certain city, that information gets to the credit team instantly, affecting how they might price a loan to a company heavily exposed to that market. This cross-platform intelligence is a powerful, hard-to-replicate advantage.
What else, especially in their core credit business?
A key differentiator is their emphasis on proprietary direct origination. Remember, they're not just buying broadly syndicated loans off the shelf. They're using their deep industry relationships and large C-suite network to source deals directly.
And doing that allows them to.
Get better terms, negotiate stronger covenants, achieve better pricing, and conduct deeper due diligence compared to participating in widely marketed deals where terms might be weaker. It leads to a potentially higher quality loan book.
Beyond just sourcing and structuring deals, do they get involved operationally with the companies they invest in or lend to?
Yes, and this is another critical one, operational expertise. ARES has a dedicated internal team called the Value Creation Team, VCT.
So not just finance guys, but people who know how to run businesses.
Exactly. And they use a proprietary systematic playbook called the ARES Value Creation System, AVCS. It's a formal process for identifying and implementing operational improvements in their portfolio companies, things like optimizing supply chains, improving sales strategies, digital transformation.
That sounds like something smaller competitors would struggle to replicate. It requires real scale and resources.
That does. It moves beyond just financial engineering to
Yeah.
actually making the underlying businesses fundamentally better, which ideally enhances returns and reduces risk.
Okay, let's position Ares relative to its main peers. You mentioned Blackstone, Apollo, KKR. How does Ares stack up?
Size-wise, Ares at $572 billion AUM is incredibly large,
Yeah.
but still below the absolute behemoths like Blackstone, around $1.2 trillion, and Brookfield, around $1 trillion. It's more comparable in scale to Apollo, roughly $840 billion, and KKR, around $686 billion.
But size isn't everything. What's Ares' strategic identity compared to those peers?
This is key. Ares' strategic DNA is overwhelmingly credit. Their brand, their history, their market perception, it's synonymous with private credit, especially direct lending.
Whereas Blackstone is maybe more known for real estate and PE. KKR for large cap buyouts.
Generally, yes. Blackstone built its initial fame on huge real estate deals and large PE funds. KKR is a pioneer of the large leveraged buyout. Apollo is also very strong in credit, particularly distressed and opportunistic credit, but Ares arguably has the broadest and deepest platform dedicated purely to performing private credit origination globally. That specialization matters.
And has that credit focus paid off recently in terms of performance?
Hugely. The data for 2023 was very telling. With rising rates making traditional PE exits difficult, private credit strategies shone. Portfolios managed by large players, including Ares, generated a median gross return of around 16.4% that year.
Wow, 16.4% in a tough year. How did that compare to PE?
It significantly outperformed typical private equity returns for that period. This stark performance difference triggered a massive strategic pivot across the entire alternative asset industry. Everyone started scrambling to build out or emphasize their private credit capabilities.
While Ares was already the established leader in that exact space.
Exactly. They were already where everyone else suddenly wanted to be. That's a powerful position.
So Ares is stable, well-positioned, has strong moats. Let's talk about recent execution. Is the growth story playing out in the numbers? Is it accelerating?
Yes, the analysis shows clear acceleration. Their overall AUM growth rate actually picked up pace. It went from a strong 16% year-over-year in 2024 to approximately 28% by mid-2025.
A 28% growth rate on such a large base is phenomenal. How do they manage that? Fundraising, deployment.
Both, and at record levels.
Mhm.
In 2024, they raised a record $93 billion in new capital commitments across their strategies. And even more impressively, they deployed a record $107 billion into new investments.
Deploying over $100 billion in a single year, the operational capacity required for that is immense.
It really is.
Yeah.
It speaks to the scale and efficiency of their platform sourcing deals, doing diligence, closing transactions across credit, real estate, PE, secondaries, all at once.
We mentioned the GCP International acquisition earlier. How much did that specific deal contribute to the growth, particularly in real assets?
It was the primary driver of the huge jump in the real assets segment. That segment saw its AUM surge by 92% year over year, largely thanks to GCP being integrated.
And was that purely an AUM play, or did it add immediate financial value?
Oh, it was definitely designed for financial impact. The deal significantly reshaped their real assets business mix toward those favored industrial and logistics sectors, and it's expected to be highly accretive to earnings.
Accretive meaning it adds to profits per share.
Yes, the estimate was that GCP would contribute around $200 million in fee-related earnings, FRE. That stable, recurring profit in its first full year after closing. That's a material boost to their core profitability from day one.
So, inorganic growth playing a key role. What about organically taking advantage of market dislocations, like the regional banking crisis in the U.S. in 2023?
That crisis, while disruptive for the banks, was frankly a golden opportunity for established private credit players like ARES.
How so? Did banks just stop lending?
Many regional banks significantly pulled back on lending, especially commercial real estate and certain types of corporate loans, due to liquidity concerns and increased regulatory scrutiny. This created, as the analysis puts it, a structural vacuum in the lending market.
A vacuum that Ares was ready to fill.
Perfectly positioned. With their massive pools of capital ready to deploy, they stepped right into that breach. It allowed them to not only gain market share, but also potentially secure better terms on loans as competition from banks temporarily faded.
And it seems like they're using this opportunity to move into bigger deals too, competing more directly with investment banks.
Yes, they're definitely moving up market. They are increasingly providing large-scale, often one-stop financing solutions for significant leveraged buyouts, LBOs, the kind of deals that historically would have required a syndicate of several large investment banks to underwrite.
So simplifying the financing process for the private equity firms doing the buyouts.
Exactly. Offering speed, certainty, and scale that can be very attractive to PE sponsors trying to get deals done quickly. It's a major strategic push.
Okay, another huge strategic initiative we need to discuss is tapping into the individual investor market, the democratization of alternatives. Why is this so important for ARES?
It's potentially transformative for their long-term growth and valuation. The traditional institutional investor market, pensions, endowments, sovereign wealth funds, is huge, but it's also relatively mature and well-penetrated by alternative managers.
Whereas the market of individual investors, high net worth, mass affluent, is much larger and less tapped.
Vastly larger. The estimated addressable market here is somewhere in the range of $80 trillion to $90 trillion. Capturing even a small slice of that represents enormous growth potential.
And ARES has a specific platform for this.
Yes, the ARES Wealth Management Solutions, AWMS, platform. It's dedicated to developing and distributing alternative investment products specifically designed for financial advisors and their individual clients.
But these products have to be different, right? You can't just offer a typical 10-year lockup fund to a retail investor.
Absolutely not. They need different structures, things like non-traded BDCs, non-traded REITs, and importantly, evergreen or interval funds. Examples are their ARES Private Markets Fund, APMF, and ARES Strategic Income Fund, AF.
What makes these semi-liquid structures suitable?
They offer investors limited liquidity provisions, typically allowing redemptions of a small percentage of the fund's net asset value, NAV, each quarter, maybe 5% per quarter. This provides individuals with some access to their capital, unlike traditional private funds, while still keeping the vast majority of the capital stable and locked up for long-term investment.
It's a balancing act, providing some liquidity without destabilizing the fund.
Precisely. It's complex to manage, but crucial for accessing the wealth channel.
And how successful has ARES been in attracting capital through AWMS so far?
The momentum is really strong. In 2024, this wealth channel accounted for a remarkable 20% of ARES' record fundraising total.
20% from individual investors. That's significant.
It is. They raised $10 billion specifically in these semi-liquid wealth products in 2024. That was a threefold increase compared to what they raised through this channel in 2023.
A tripling in 1 year. That shows real traction.
It does. This capital is considered very attractive. It's often described as stickier, potentially less fee-sensitive than institutional money, and it fits perfectly with their focus on perpetual or long-duration strategies.
And the expectation is that success here could lead to a higher valuation for ARES overall.
That's the key investment thesis for many analysts. Successfully building a large, stable retail channel could lead to a significant valuation re-rating for ARES' stock, as the market typically assigns a higher multiple to managers with diversified, sticky, retail-sourced AUM.
Okay, we've covered the strategy, the structure, the growth plays. Let's get down to the bottom line. the financial performance metrics analysts really focus on, especially those non-GAAP numbers.
Right, because standard GAAP accounting doesn't always capture the true economic reality of these firms. The absolute key metric is fee-related earnings, or FRE.
Remind us what FRE represents again.
It's the core, stable profitability. You take the predictable management fees and you subtract the compensation costs and regular operating expenses associated with generating those fees. It excludes the volatile performance fees.
So it shows the underlying health of the recurring revenue business. How has ARES FRE been performing?
Very strongly. In the second quarter of 2025, FRE grew 26% year over year, hitting $409.1 million.
A 26% growth in core earnings is impressive. Does that show operating leverage?
Yes, exactly. Management fees grew about 24% in that period, but FRE grew 26%. That means that as revenues grew, costs grew slower, so profitability improved. The incremental revenue was dropping more efficiently to the bottom line.
Which improves their profit margin.
Correct. Their estimated FRE margin reached 45.4% in Q2 2025. That's a very healthy margin, indicating the scalability of the platform. Managing more assets isn't requiring a proportional increase in costs.
Okay, FRE is the stable engine.
Yes.
What's the other key non-GAAP metric?
That would be distributable earnings, or DE. Some firms call it realized income. This captures the total cash earnings available to be distributed to shareholders.
So DE includes the stable FRE plus any performance fees that were actually realized cashed in during the period.
Precisely. DE equaled FRE plus realized net performance fees, after accounting for compensation tied to those fees. It gives you a picture of the total cash generation, including that lumpy upside.
And how did DE perform?
DE per share grew 4% year over year in Q2 2025. The growth rate here can be more volatile than FRE because it depends on those market-dependent realizations. You need to track both metrics together to get the full story.
FRE for stability and the dividend coverage. DE for the total cash picture. Got it. Now, no deep dive is complete without looking at the risks. What are the key headwinds or potential challenges facing ARES?
We've touched on some, but let's consolidate. First, interest rate sensitivity is a double-edged sword.
How so? They benefited initially from floating rates.
Yes, with around 85% of their debt assets being floating rate as of late 2024, rising rates initially boosted their interest income. However, a higher for longer rate environment significantly increases the debt service burden on their borrowers.
Which increases default risk.
Exactly. It stresses the portfolio companies, potentially leading to higher defaults, loan modifications, and credit losses for ARES funds. Managing this credit risk in a high-rate world is paramount.
Okay, risk number one, sustained high rates hurting borrowers. What's next?
Risk number two, the closed exit window. We talked about the J-curve. ARES' ability to generate significant distributable earnings and return capital to its fund investors relies heavily on healthy M&A and IPO markets for realizing carried interest. A prolonged shutdown of exit activity severely constrains DE growth and LP returns.
Market dependency for the upside. Makes sense. Risk three.
Regulatory risk. There's always increasing scrutiny from regulators like the SEC, particularly around private fund fees, transparency, and disclosures. New regulations could increase compliance costs or restrict certain practices.
And related to that, there's always the political dimension, right?
Yes. Risk number four is political risk, specifically the perennial threat of changes to the tax treatment of carried interest. If politicians decide to tax carried interest as ordinary income instead of lower long-term capital gains rates,
That would take a huge bite out of the net economics for managers across the entire private equity and alternative asset industry.
it would significantly impact profitability and potentially the attractiveness of working in the industry. It's a recurring threat they constantly lobby against.
And one final risk tied to that new wealth channel.
Right. Risk number five, redemption risk. While their core institutional capital is very locked up, those semi-liquid products designed for the wealth channel do have redemption features, like the 5% NAV per quarter.
So what's the risk there?
In a severe market downturn or a crisis of confidence, you could see a surge in redemption requests from those wealth management clients. If requests exceed the quarterly limit, the fund might have to gate withdrawals, meaning stop or limit redemptions.
Which wouldn't make investors happy.
Not at all. It could damage the brand and investor trust. In a worst-case scenario, if they had to meet large redemptions, it might force them to sell assets into a falling market at unfavorable prices, hurting performance for the remaining investors. Managing this liquidity mismatch is a key challenge of the retail strategy.
Okay, a clear set of risks to watch. Let's wrap up with valuation. How does the market value ARES today? considering this mix of stable earnings, growth potential, and risks?
Analysts typically look at valuation multiples based on both FRE, for the stable part, and DE, for the total earnings. Comparing ARES to its peers, it trades at a forward price-to-earnings PE ratio of about 31.36x.
How does that 31x compare?
It's generally a premium compared to peers like Apollo and KKR, but interestingly, it's currently a slight discount compared to Blackstone, which often commands the highest multiple in the group, around 34x.
So ARES gets a solid valuation reflecting its strengths, but maybe not quite the top premium of Blackstone. What does that valuation imply the market expects from ARES?
A premium multiple like that implies the market is baking in expectations for sustained, above-average growth. It assumes successful execution on key initiatives, especially continued strong deployment, growth in the wealth channel, and the ongoing strength of the private credit cycle where ARES leads.
So the pressure is on to deliver on those growth fronts.
Absolutely. If ARES stumbles on deployment, if the wealth channel growth slows significantly, or if the credit cycle turns unexpectedly sour, that premium valuation could be at risk. The market is paying for continued strong execution and capturing of these secular trends. #outro.
Okay, let's synthesize this. After this deep dive, ARES management emerges as a really compelling but complex investment profile. It seems like a hybrid.
I think that's a great way to put it. It's a combination of significant growth potential driven by their leadership in the private credit supercycle and their aggressive push into the wealth channel.
Mixed with a strong element of income and stability, supported by that incredibly robust base of fee-related earnings from long-term capital.
And that stable FRE is what underpins their consistent and growing dividend. They've maintained that payout for 12 consecutive years, which speaks volumes about the reliability of the core earnings engine.
So for you, the listener, trying to track ARES going forward, what are the absolute key metrics to keep an eye on?
I'd focus on three things. First, quarterly net inflows, especially the breakdown showing flows into the wealth channel products. That validates the retail strategy's momentum.
Okay, inflows.
Second, the deployment rate of that massive $86.8 billion in shadow AUM or dry powder. How quickly and effectively are they putting that capital to work? Because deployment directly translates into new high-margin management fees.
Makes sense. Deployment fuels FRE. And the third metric?
Continued FRE growth and margin expansion. Is that core fee-related earnings engine still growing strongly? And is the FRE margin holding up or ideally expanding above that 45% level? That proves the scalability and efficiency of the entire platform.
Inflows, deployment, FRE margin. Got it. It really feels like ARES, with its deep focus on private credit, isn't just another financial firm anymore. They're becoming part of the essential plumbing of modern finance.
You could argue that. As traditional banks continue to face regulatory pressure and potentially pull back further, private credit providers like ARES are stepping in to fund huge portions of the economy, especially the vital middle market.
Which leads us to our final provocative thought for you to consider. We see private credit stepping into the void left by regional banks, and now even competing on large LBO deals.
The question is, how much further does this structural shift go? Could we reach a point where the private credit market, dominated by firms like ARES, actually becomes the primary engine of corporate lending for the global middle market, effectively displacing banks in that role?
A fundamental reshaping of the financial landscape. The future scale and influence of ARES are certainly tied to that very question.
Definitely something to watch.
And that wraps up our deep dive into ARES Management Corporation. Thanks for joining us.
See you next time.